Good morning and welcome to the B.F. Anderson Technical Report for November 21st. First of all, I'd like to say happy Thanksgiving to everyone. We have a lot to be grateful for. This is the greatest country in the world, as you can see by all the news lately about the caravan and the people coming up from Honduras. They have no concept of the wonderful life that we have. You know, back in the 1980s, I met a gentleman by the name of Bert Loeb. He was with a firm called Dorsey & Company. I was working for Dorsey & Company, little small firm down on Gravier Street, New Orleans. It was a wonderful company. I really enjoyed working with them. And Bert Loeb, who at the time was probably in his 80s, introduced me to a friend of his by the name of Carlton Lutz. And Carlton was attempting to teach me a concept that I rejected initially, but after observing over a period of time, came to realize that Carlton was teaching me something very valuable. And what he was teaching me was something called trend following. And Carlton told me, he said, you know, when it comes to understanding investing in the stock market, if the trends are down and you're a long-only investor, which we are, it's very difficult, if not impossible, to make money in the market. So trend following and understanding the trends of the overall market are critical. Because what happened to me was in the year 2000, between 1995 and 2000, my portfolios went up approximately 1,300%. We were in the dot-coms and we did well. I knew it was getting frothy in 2000, so I put a stop loss on my stocks. And for example, I had a stop loss on Amazon. The stock hit 100 for the first time. I had a stop in at 80. It dropped to 80. I sold out. And then it proceeded to drop to $8 a share from 80. Now, the mistake I made was I was not trend following at the time, and I kept trying to fight the tape. I kept trying to get back in again. And every time I got back in again, I got burned. Therefore, you know, it was a mistake. Now, I witnessed the same thing in the financial meltdown of 2008. So after going through two bear markets, I finally realized that there's something to this trend following, because as long as the trends are down, you stay defensive. You don't try to get back in. So let's look at the charts real quick. Here we have the NASDAQ composite again. This is our daily NASDAQ. Yesterday the market was down quite a bit. The Dow was down over 500 points. And if you look at the volume here on the NASDAQ, it was slightly above average, above more volume the prior 2 days and more volume than the last up day. As you can see, we're continuing to see this downtrend that really got started around September the 23rd, when we got this robust institutional selling, which drove the index down below the lower moving averages, and the trend is down. So on the NASDAQ, the trend is down. So just be aware of that. Now, if we look at the weekly, just really want to look at mainly last couple of weeks, you can see that we've been getting, you know, we got a good week about 3 weeks ago, a little bit better week, and then a bad week. Now, this week is going to be hard to use the volume because we're going to have a shortened trading week. But you can see here that the trend on a weekly basis is also down. Remember, the rule on the trend following is if you get 2 consecutive weeks, now each line represents a week, you do 2 consecutive weeks below the 35-week moving average, that is a sell signal. So we are on the first graph on the daily where the trend is down. On a weekly basis, the trend is down. The moving average is flattening out and will probably turn down. So, you know, we can fight the tape all day. Now, this is the high-low index. This is the number of new highs divided by the number of new highs plus new lows. We got back above 30, but you can see, you know, the number of new lows are picking back up again. As you can see in the next chart, you can see that, you know, as of yesterday, we had 252 new lows, and then on the prior day, 242 new lows. Again, we want to see stabilization under 40 new lows a day. We're not getting it. and the trend is down, don't fight the tape. Now, on the long-term graph, which is the 10-month versus the 20-month, not looking good, because, as I said, if we get this death cross, that's going to be a definite warning that, that the market is really rolling over in a serious way. So again, the index is now below the upper moving average. The upper moving average has turned down. Question is, will it cross? We'll have to see. Now, one thing I did want to mention here, the economy is doing great. If we just step back a minute and say, okay, is there a recession out there? Well, I'm going to tell you, there are recession fears, and that may be what's causing a lot of this difficult market activity. However, don't get too bearish, because, we're seeing this is a graph called the Industrial Production Index, which is basically a graph of all industrial activity that has taken place in the country. Last week, now it's published every month, so as of the end of October, you can see that industrial production hit an all-time new high. So the economy is really, really doing well. Now, something just to keep from getting too bearish here, let's look at something here. This is a graph, and I went back to 2007, 2008, the financial crisis. Now, if investors are really worried about recession, they're going to run to bonds. Everybody's going to, all the institutional guys, everybody's going to run to bonds. Well, you can see here what started to happen in 2000, 2008, and this is a ratio now. This is a ratio of the S&P 500 compared to the long-term Treasury bond. So when the line is going down, it's saying that bond prices are holding up because people are moving money out of the stock market into bonds, and you can see the definite downtrend that got started in the summer of 2007, really pretty much way in advance of the major drop that took place in 2008. So you can see the pattern. It's a downtrend. Bonds are doing better than stocks. Now, if we look at it today, we are seeing somewhat of a near-term breakdown in this ratio, because this is the exact same ratio comparing the S&P 500 to the long-term bond. However, you could argue that this ratio is still in an uptrend. We're not seeing a massive exodus out of stocks into bonds. And I think the reason for that is that we are what appears to be a rising interest rate environment. Therefore, people are somewhat fearful of bonds and therefore not really jumping into bonds. But it is something to keep an eye on. Now, on the fear-greed index, we've got the put-call ratio, which is what we're using here, equity-only put-call ratio. We're back up in extreme fear. Now, remember, this is a contrarian indicator, and this is a positive, by the way. If you're thinking about putting money in the market or adding to your portfolio, I would really be thinking about it now. I'm not saying to buy stocks. I'm just simply saying get more cash into your portfolio. That way, when this thing finally does turn and the trends do turn up, and the trends will turn up, it's just a matter of when, you want to be in a position to add to your portfolio. Whereas if you wait till we're into extreme greed, that's usually where the market forms some type of a top. So we are trying to bottom here, and again, this contrarian indicator is saying, things are bad. Everyone's fearful. We're getting extreme readings here. Not as extreme as we got back in the summer of 17, but we are getting somewhat of an extreme reading here, and I would say this would be a good time to be putting money into your portfolio and not taking money out of your portfolio. Now, one last comment. I do not have a watch list this week. It just doesn't make sense to have a watch list right now. If the market was, acting better and we had somewhat of an uptrend, but because the trends are down, and the trend is down, and you can call it a bear market, you can call it a birdie market, you can call it whatever you want. I just say call it a downtrending market. This is a downtrending market. There really isn't anything out there that I can find that is really even worth watching right now, because every time I see something that looks good, it breaks out to a new high, it fails, comes back down again, especially with the retail stocks. The retail stocks got really hit hard yesterday. So everyone, have a happy Thanksgiving, and if you have any questions, feel free to give me a call. Thank you.